Welcome back. It looks like Florida's housing market could be facing a perfect storm. I came across this interesting post on LinkedIn, and it really shed some light on the incredible challenges that will be facing that market. So let's just take a quick look here. It says, as the summer hurricane season draws near, Floridians could be facing a perfect storm that's brewing on the state's housing market. And it says in April, the median home price in the state fell 3.1% year over year. That's notable because it is, in fact, the biggest drop of any state in home prices. And then you have, of course, home insurance rates, which are continuing to climb. So this is just quite the mess. And then, of course, you have the condominiums. I don't know if you followed the news in recent years. After that one condominium collapsed, we saw assessment prices in Florida for condos also skyrocket. So those are becoming more expensive, and that's really putting the hurt on older homeowners that are living in condos. So there are several links here, but one thing I wanted to note is Lori Rose. She's a realtor, and she is seeing some other problems in the Naples, Florida area. And so she says that right now, that Florida, the state of Florida, is sitting on a year's worth of housing inventory. Can you believe that? A year's worth. And so inventory is increasing, demand is cooling, and sellers are beginning to face the harsh reality. Your prices, you can't be selling a home at 2021 prices or 2022 at 2025 interest rates. It just doesn't work that way. In fact, here's one of her videos where she's sharing some of the changes and showing some of the graphs and the changes of housing inventory. But what I found most interesting was a comment from one of her viewers who said that I bought my house in Southeast Florida in 2021 for $280,000. 5 months later, another house with the same floor plan sold for $330,000. 6 months after that, they were selling for over $400,000. But now, sellers are listing them for $350,000, and guess what? They're not selling. And the market has definitely turned into what this commenter says is a buyer's market, and I would agree. Ground level reports such as these are very unsettling for homeowners in the state of Florida who are trying to sell. They're going to face the specter of having to dramatically reduce their asking price, or they're going to end up having to do what I call the kiss of death on a house listing or real estate listing, and that is to repeatedly reduce the asking price of the home. And so that's where folks find themselves. Then we have a recent Bloomberg column. This column notes that in Florida, the high cost of living combined with climate change may deepen the down phase of this boom to bust cycle. So they're seeing the writing on the wall as well. So we have sky high insurance rates, condo fees that we mentioned earlier, all this stemming, of course, from extreme weather and natural disasters. So the climate burden on state homeowners is not likely to change, and this is a non-cyclical phenomena, said Jesse Keenan, a real estate professor at Tulane University, who focuses on climate adaptation. It's resetting the baseline of values of home values in the state of Florida, he noted. And then, as we mentioned earlier, home prices dropped 3.1% in April from a year earlier, biggest drop of any state, according to Redfin. But here's the problem. We're going to be looking at more hurricanes. I had to get out of the state of Florida in a big hurry. My wife and I did a couple of years ago, but that was because of Hurricane Ian. But this year, hurricane forecasters are expecting a very active Atlantic hurricane season, which, by the way, begins in June. So we'll see how things go next month, and it runs as late as October, sometimes even November, as those waters continue to heat up. Then there's Josh Levy, the mayor of Hollywood, Florida, and he testified on May 13th at a Senate Environmental and Public Works Committee hearing on the state's insurance costs, saying that we are facing overlapping climate-driven pressures that are placing extreme stress on our residents. And that is being felt especially for those on a fixed income. Assurance rates, are pushing them to the brink Many residents are paying more for insurance than they do for property taxes or even just the principal on their mortgage. If you've been watching HECMWorld.com, then you've probably recall some of these facts that we have stated earlier, actually even last year. So the the Trump administration's plan to pull back from disaster relief could exasperate this, but again, that all depends what the Trump administration decides to do with FEMA. There was obviously some improvements that were needed, but the agency, what the Trump administration is looking to do is to kind of roll it back to the states to manage and administer. I just don't see how FEMA would move out from under the umbrella of federal authority. So in conclusion, the Florida housing market could be facing a perfect storm. I don't see how it avoids it because homeowners' insurance costs are going to keep going up. Every storm just justifies more insurance premium hikes. And then we have condo assessment fees. And I think that Florida is where you're going to see a lot of folks that may have to make a move out of their home, or they're going to have to look for other ways to fund their retirement in the Sunshine State. Do you know that we have one reverse mortgage CEO with a doctorate in economics who worked for the Federal Reserve at one point, served as an Ivy League professor, and loves to get wonky about policy? Yes, all the details of policy. Now, if you do know, then you know that we're talking about Chris Mayer, the CEO of Longbridge Financial, and last month, National Mortgage News interviewed Mayer for his take on senior home equity and the challenges of increasing access to housing wealth, a very timely topic. So let's see what they have to say here. And they talk about his background. We're going to go right into the meat of the interview itself. So here's one. What do you think the prospects are for the reverse mortgage market, given where home equity levels sit currently? And he notes that a third of all homes in the U.S. are owned by those who are 65 and older. And that's going to continue to increase because people are buying homes later. I covered a couple weeks ago that baby boomers, surprisingly, are the largest cohort of home buyers. But then I thought about it, maybe not so surprising, because they're the ones that have the financial means to actually purchase a home, whereas young people do not as much, and they're really struggling to get into their first home. So they generally don't go, speaking of older homeowners, from being a renter later in life. People are living longer, baby boomers are getting older. All those metrics suggest a growing market. He says we don't do a very good job in the mortgage industry of serving older Americans. I would agree. And that's the problem he sees, and their company is built to address Longbridge. And Mayer notes that is the goal, to serve the senior. By the way, that doesn't mean we're always going to be talking about reverse mortgages, which I think is a more holistic approach, but it means we care about the products that we think are responsible, a good fit for seniors. And then the age-old question of what barriers do you see for consumers looking into reverse mortgages? And I think he hits the nail on the head here. Misconceptions create a role in people thinking that a reverse mortgage is not an appropriate product for them. For us, it's important that we have people feel comfortable about the product and people they trust to understand the product. Our view is when someone 65 comes to a mortgage lender, they've reached out to the mortgage lender because that mortgage lender is an expert in that field, and loan officers should actually talk to the person about a reverse mortgage, just in the same way that a first-time home buyer would be presented with a 30-year fixed conventional loan or other options. And there may be first-time home buyer programs. So in a holistic approach of mortgage lending, the reverse mortgage should certainly come into the conversation. Of course, one of the most common misconceptions is that the bank takes your home. And Mayer notes, people have that misperception. Literally, the word mortgage means you're borrowing money. So you can begin with, no, we don't want to own your home. I promise you as a lender, no one wants to own your house. And that's very true. But I would say a lot of people are starting to ask me questions about the product. I think this about reverse mortgages, but I want to know X. And that's sort of more of the reaction Mayer gets. I think for a lot of people, it's more a question of curiosity and wanting to know a little bit more. And then the recent economic developments, we're talking about potential recession. I think personally that's been overblown, and the markets are already higher than they were before the tariffs were announced. But nonetheless, there is still uncertainty in the hearts and minds of many people. What's going to happen with all these massive changes? And Mayer talks about how the reverse mortgage can really help buffer some of those uncertain times. And he observed, for example, the HECM reached, this is a very interesting point, by the way. He says, for example, the reverse mortgage world, or HECMWorld, no pun intended, hit its peak in 2009. So there's definitely a counter-cyclical nature to the product. In other words, we were in the midst of a real economic crisis, housing crash, and that's the same year that reverse mortgage endorsements hit their peak. And so at times like that, consumers are more uncertain, and they tend to be times when relying on home equity as a buffer is helpful, and I would add also more accepted at that time. So we're going to include links to this column and as well as the other stories on today's show so you can read them for yourself. But I thought it was interesting to hear Chris Mayer's perception, especially as an economist and a reverse mortgage lender. So are baby boomers mucking up the housing market? Well, that's been a common claim by many, but we're going to see here in a moment, it's just not quite that simple. But I came across a very interesting column in MSN, and it's quoting Meredith Whitney. She's known as the Oracle of Wall Street because she predicted the great financial crisis of 2008 and housing crash. But she said that many cash-strapped Americans have been borrowing against their homes. But here's the shocking number for me. 44% of those home equity loans are being taken out by seniors, which is counterintuitive. I would agree. It's crazy, right? But why are they doing this? So, of course, many would assume that baby boomers are sitting on a mountain of cash and a mountain of home equity, but those who have a lot of money, of course, can purchase homes, and thus they're the largest cohort. 42% of home buyers are, in fact, baby boomers, and millennials only account for 29% because they're having a big challenge when it comes to affordability. So while most of the buyers are boomers, it doesn't mean that all boomers are sitting on a lot of cash where they can afford a home. So since many baby boomers are not cash rich or asset rich, many are forced to stay and age in place. And she added that the high mortgage rates have also had a lock-in effect where homeowners who got into the market when rates were low are obviously going to think twice before selling and having to buy a new home. And then looking a little bit deeper, I came across a very interesting column in Mortgage Reports, and this is looking at the housing ladder jam. And I thought this was a very interesting and insightful analogy given. So it's talking about the younger home buyer ready to buy their first home, only to find few, if any, homes available. And so let's talk about the rungs of this ladder. So picture your local housing market, he writes, as a ladder, and you're trying to step onto the first rung as a first-time home buyer. The problem is that rung's crowded with those who want to move up as well, but they can't because the rungs up above are also full, and those are full with seniors that are aging in place, many who would like to downsize and have nowhere to go. So this is creating a real restriction in housing inventory as well. Warden notes that these seniors do want to move or even go into assisted living but don't have the means to do so. Then he mentions the March 2025 report from the Urban Institute. The Urban Institute summarized the problem in its March 2025 report, America's Housing Market is Failing Older Adults, saying the U.S. population is aging. Within the next decade, older adults will be outnumbering children for the first time in American history. As Americans live longer, their housing needs will change, but our current housing market is ill-prepared for this demographic shift. And so let's look at the U.S. Census Bureau breakdown of older population. And yes, it's a steady growth, and with lower birth rates, this is going to become a real burden also on our our Social Security and Medicare and other programs as well. We have fewer people paying into the system, which is a challenge. However, in the end, this is not just the fault of seniors or baby boomers. Many of them are desperate to move, but others are unable to do so. So they are basically stuck. Many of them are fixed incomes, as the Urban Institute notes, and they are facing a real phalanx of problems when it comes to housing affordability, accessibility, and availability, because we are seeing them pressured by not only the cost of their home, but then the cost of property taxes, homeowners insurance, as we just discussed in the state of Florida, maintenance, and then even homeowners association fees, which is really putting stress on their income. So this column really addresses, I think, why we're seeing a lot of folks choosing to stay put. Many times it's out of necessity, not out of choice. And what's also interesting is this. The Institute found or estimates that 11.7 million senior households are now spending over half, more than 50% of their income on housing costs, which they classify as severely cost-burdened senior households. And that's more than rents, but it's also the utilities, maintenance, property taxes, et cetera. So that's just really a snapshot of where we find ourselves in the market today. And I think it's good to know that this is a problem that is not going away quickly, and there may be an opportunity where a reverse mortgage could in fact be that solution.